Hey, hello everyone, and welcome. I'm John Humphreys. I'm the Executive Director for the Association for Equity and Funding, and I'm proud to continue our YouTube series of webinars and workshops regarding issues that are important to AEF members. We have a series of financial strategy sessions specifically geared to low revenue districts like our members. And these members fit a critical need. We have to be as creative, strategic, and efficient as possible to succeed in a marketplace where other districts get more money per pupil than we do. Some of the organizations cover a wider variety of financial topics. AEF hopes to take the conversation to the next level with widely available, actionable information to help districts succeed. Our guest today is Matt Silkey. Matt is Associate Vice President of Investment Services at PMA. He's going to talk a little bit about cash flow analysis, but then give us a market update. And things are certainly changing quickly in the marketplace, Matt, as districts go out to both borrow and invest. And I think it'll be really useful to have this timely information. Thank you for joining us, and I'll hand the screen over to you.
All right. Thanks, John. Good morning, everybody. Can everybody hear me okay? A little nod. Awesome. And then can everybody see my screen here? They should be able to see just the title screen. Cash flow analysis and investing. So I actually did a session about 6 months ago, and I think the way that John and I had worked this out is that we would get together, I think, once every 6 months and do a little bit of a market update. So this is actually the first update that we'll be doing since the first presentation we gave back in March. And because we did one back in March about cash flow and investing, John asked me to sort of just rebuff the topic and kind of walk through it fairly quickly, and then kind of get into a little bit of the market update. So obviously, my name is Matt. I work at PMA. I'm the Associate Vice President of Investment Services, but that does not mean that I only work with people on investments. I do a number of other services for districts. One of those things is cash flow analysis, which we utilize for a few different things. You'll see that we utilize it for investment optimization, but also what we won't talk about today is that we utilize it for analyzing for short-term borrowing needs. And so obviously PMA is pretty busy in the state. I think some of you might know who we are already, but we've been around for about 38 years. Within the state, we've got about 285 participants. That's made up predominantly of school districts, but also counties, municipalities, and tech colleges as well. Company as a whole, we've got about $32.5 billion in assets under management. We are in 14 states. I only work in Wisconsin, but we do operate a number of LGIPs around the country. So cash flowing, I think it's usually on the forefront of everybody's mind about this time of year. A lot of districts around the state kind of get tight around November, December. And then there are a couple different areas around the year where some districts can get tight as well. But by and large, it's usually late November, early December, or right before taxes in January. And so what does this analysis do? It helps districts meet their liquidity needs. It's a management tool. It helps people predict when they will be at a shortfall or when they will have their largest influxes of money and what they can do with those dollars. And then they can plan for investing those dollars and maybe earning a little bit more on the long end of their particular cash flow schedule. So where does this begin? So it's not too difficult of a process to begin. It is more laborious in the beginning just to kind of get the cash flow up and running. But then obviously once you kind of get that going, you can edit it, augment it however you want. It's really more of a living, breathing thing that becomes a conversation piece between us and a district to kind of better plan for their future needs and future opportunities. So we utilize funds 10, 27, 50, and 80 for the purposes of this. Ideally, we would get 3 years of history, but we can certainly work with 1 year of history. We do not take a look at debt service. We do not include that. And then what we'll do is we'll also take a look at the actuals and the actuals from the previous fiscal year. So ideally, this is on a cash basis. So we'll take a look at maybe some bank statements and stuff like that. It can be a bit of a stretch sometimes for districts who only work on an accrual basis, but we're generally very comfortable manipulating those numbers to reflect more of a cash basis. And so we'll take future budget data, we'll take historical data, and we will project forward the percentages of those months over time based upon the new budget. And what we get from that is a schedule of projected expenses and a schedule of projected revenues for the future fiscal year or future fiscal years, however far out you want to take a look. And it's a very helpful tool. So,
hey, Matt,
yes.
On that slide, just question for you: are those charts, are those kind of averages of what you've seen in districts overall?
These are just samples. So this is
Okay.
more or less just to basically show that your revenues are highly inconsistent and more or less your expenditures are going to be consistent across the board. So it's different than what we've heard from many other states. You guys are tasked with working with a very inconsistent revenue schedule. So that's really just a visual representation of that.
Okay. All right. Thank you.
So when it comes to fine tuning your cash flow, we kind of open up the discussion about, one-time transfers out, one-time transfers in. A transfer in could be maybe money from a TID. A transfer out could be potentially a Fund 46 transfer. And then we'll work with a district to really fine tune their payroll dates. So some districts have separate hourly, separate admin, separate teachers and nurses. Some districts have 26 pay periods, some have 22. And so we really try and fine tune that cash flow to reflect those custom payrolls throughout the fiscal year. And then this is just sort of what you'll get is an analysis of budget by source, budget by category. And this is kind of where we pulled the visual representations of. This is just a very basic visual representation of a district's cash flow in and a cash flow out. But more helpful than that, we are able to provide the monthly projections and the monthly fund balances. And then in the bottom right hand of the screen is actually what is more of like a calendar approach. So this shows a district's AP run. This shows a district's payroll cycle, basically on the 12-month fiscal year calendar basis. And so it's one of those little pinup tools that people can utilize within your office to kind of keep them, top of mind and let people know, hey, this is sort of our schedule. This is what's up and coming. And then from all of this, we actually are able to break it down into a daily cash flow balance. So this particular district here, August of 2021, is entering the month with about $13.8 million. We've got some August taxes and some August state aid rolling in there. We've got some AP rolling out. We average out AP typically each month. And then we have the payrolls in there, of course, for about $7 million twice a year or twice a month. This particular district is at the 11th and 27th of each month. And then we have also got built in there $4.9 million of investments, $7.6 million of maturities, and then another $200,000 of investments rolling out there at the end of the month. Really what this does is it allows us to ask the district, what is the minimum level of liquidity that you are comfortable having on any given day? And let's say you say that's 5 million. What we'll do is we will go ahead and invest those dollars based upon your cash flow and make sure that when your cash balances on the cash flow analysis approach that 5 million mark, we have a maturity rolling in to go ahead and fund the liabilities that are needed to run the district. And so this is one of the more valuable outputs that we are able to take from the cash flow analysis. So again, it's analyzing your cash flow needs to maximize an investment horizon. It's making sure that your investments match your liabilities and making sure that you always have enough cash on hand to be flexible with those liabilities if they change. And then it's optimizing your yields along the yield curve. So here again, it's just another output, another representation of a multi-year cash flow graph. So this particular district actually does need to short-term borrow to meet their liability needs. But what you see here is the band across the bottom is going to be the minimum liquidity the district wanted, which looks to be about $7.5 million. The green is going to be liquid investments, and then blue is sort of how we're able to build in those longer or mid-term investments. So 6 months to a year, 1 year plus. And it just kind of shows you how we can kind of stair step those maturities down for any particular district so that that money arrives right when the district needs it. And how we do that is by providing districts with essentially a plan on paper so that this district knows on August 26th, 2021, they are able to invest $7.6 million for 42 days based upon their cash flow schedule. I'm sorry, July 15th, 2021. They're able to invest $7.6 million for 42 days, $7.9 million for 56 days, and so on and so forth. So the idea is that there's no wasted time. So when your state aid or taxes arrive, you're able to invest out for the exact number of days that you are able to, and really optimize your yields. So how we go ahead and optimize those yields, we actually have a network of financial institutions here. We have a band of securities dealers that we will go ahead and bid out each one of these investments for, so that on any given business day, you are ideally getting what you could consider one of the highest yields in the market on that given day. In the state of Wisconsin, you guys are limited by state statute 660603. So this comes down to a very limited number of vanilla and fixed income investments. So bank deposits, treasuries, agencies, repurchase agreements, and commercial paper are allowed. We do have the ability to sell those types of investments to individual investors, but as a broker dealer in the state, we choose more or less not to. And this isn't because the returns are poor, because the returns are there. We utilize those more in our pools. So we operate WISC, the Wisconsin Investment Series Cooperative, and we will utilize commercial paper to increase the yield within our pool because the risk is more diversified amongst all the participants. Commercial paper is certainly one of the more risky investments that is allowed under 660603. And because of that, we have decided as a company basically to limit that risk in how we offer that. So, that kind of completes, I suppose, just a really quick recap of how we cash flow with people. If there's any questions at all right now before I kind of jump into a market outlook, I'm happy to answer them.
I might ask a rookie question, Matt.
Yeah.
If you go back a couple slides and it showed where the district was short-term borrowing,
yep.
There. When you create your schedule, do you is it sometimes worth it to invest even though you might be short-term borrowing?
So we're going to be running into that this year. So we actually we operate our own short-term borrowing pools. So I think this year we have 17 districts for around $97 million that we have split up into 2 different pools. And basically what that does is it attracts more bids for your short-term debt and better rates for your short-term debt. We actually do have a couple one-off taxable issues this year as well, because they have already issued debt this year. And obviously, there are rules regulating how many times you can issue tax exempt debt on a given basis. But one thing that we will need to do this year, because of where borrowing rates are and where investment rates are going to be, is we will have to run an arbitrage analysis to make sure that districts are complying with the arbitrage rebate rules that the IRS has set forth for tax exempt borrowing. So basically, it's just that you're not earning more than you're paying on your debt. And so this is something that we come up against in bond proceeds often enough, but it can also pop up with some short-term borrowing as well.
Okay, thank you.
Yeah. So, well, the Fed does meet today. They will probably be discussing with us, or I should say, Fed Chairman Powell will probably be on the podium about 1 p.m. to discuss their decision with what they're going to do with the federal effective funds rate. What you see here is a U.S. Treasury yield curve. Now, are you guys able to see my mouse on the screen?
Yes.
Okay, so this is where we were a year ago. So this is the yield curve, basically showing 1 month rates out to 30-year rates. These are tax exempt rates. These are Treasury rates, essentially. Now, fast forward only 9 months, and you can see just the massive hike in rates that we have seen since last September. Obviously, this is a reaction to inflationary pressures and prices in the market. You can see where we project to be today. So this is where we're looking today, and then this dotted line is where we're looking to be a year from now. So essentially, what the Fed is doing is they are bumping up these very short-term rates, and this is a reaction again to inflation to try and increase the cost of borrowing so that people are essentially spending their money slower. It's pretty historic where we are at this point in time. We haven't seen hikes like this in, well, at least not my professional memory, but probably since the early 80s, I would say. So kind of take a look into the future again here. So this is one of the outputs that we will see probably this afternoon. This one was updated with an assumption of a 75 basis point hike. So these dots represent where each member of the Federal Open Market Committee believe interest rates should be as of a specific point in time. So you can see that they're probably going to be bumping up rates until 2023 or early 2023. And then following that, that's when they really feel the recession is going to kind of show its head here. Really, over the last couple weeks, stocks and bonds have sold off considerably. There's been a lot of upside surprise around core CPI, which is the consumer price index. It's kind of the gold standard for the basket market of goods that consumers purchase on any given week. Headline numbers of that were up around 4.5% to 5%. So these dot plots are not surprising at all. 9 months ago is when we started to hike rates, and we're really just now seeing those rates actually enter the markets. Labor numbers actually continue to grow. They're in a great spot, but wage figures are continuing to lag. And that's really not helping anybody's wallet. By and large, most measures of profitability in the markets, over the last quarter are fairly decent looking, even given the lower expectations. Quarterly earnings across the board have been relatively healthy. I would say probably a week ago, we were looking at 2 to 3 hikes today. That would be 50 to 75 basis points. Probably now we're looking 75 to 100 basis points in a move for the Fed. Most people are thinking 75, but there's been increasing discussion about a 1% hike. Just some massive moves in the market, historic moves. I would say that the market is expecting the Fed to be done moving by early 2023, as you can kind of see here on this dot plot, which is great for savers. But really, I would say that most of these rate hikes are already baked into the yields that we're seeing in the market. This is just another output that we like to take a look at. So essentially, if you think of one hike here as 25 basis points, they're expecting that by mid-December, we are going to be at plus 7.5 hikes. So, I mean, you can think about that as 1.75% in the market. You know, and then on through the beginning of 2023, maybe another 50 to 75 basis points after that. So we're definitely not done yet. There are still rate hikes to come after what is done today. Spreads, I would say, across the board remained relatively stable over the last couple weeks. Stocks actually are near a 1 month low, so maybe not a bad time to get in there, or any risk market for that matter. Prices are certainly lower. Long-term inflation expectations have come down to maybe like 2.5 to 3%. So maybe not where the Fed wants it, but again, largely overall economic data has been positive. Returns right now in the investment grade market are approaching 4 to 5%. So it's not a bad time to be thinking about any fixed income investments. The 10-year spread over the S&P returns is at actually a historic high right now. So basically what that is you're looking at average returns in the S&P market, and then 10-year returns in the Treasury. And so that kind of spread is at 2 to 2.5%. And really what happens when we get to that is people should sort of kind of take a step back and maybe reassess their long-term approaches to investing. Total returns over the year, unfortunately, there really hasn't been anywhere to hide. I would say probably cash has been the best place to be thus far. We are expecting a lot of data this week, most of it on the home front, but I think this week is definitely about the Fed. They are expected to move, like I said, 75 to 100 basis points. But it's really with everything that comes out this week about that and what they choose to do with the federal effective funds rate. So what does that really mean for your investing? I would say it still makes sense to invest to your liabilities. That means really disciplining yourself and not chasing shorter yields. So, you know, the 1-year rate's going to be higher than the 18-month or the 24-month rate right now with the inverted yield curve. And that's just basically just a projection of a recession. But if you have an opportunity to invest out past that 1-year mark, I would say absolutely do so. We are projecting rates will go down. So there is going to be some reinvestment risk at that 1-year mark. And I would say don't wait for the Fed hikes that we're talking about. If you have the opportunity to invest now for a period of longer than where maybe the peak rates are, take that opportunity, invest your liabilities, you know, really stay disciplined, because that's going to be the most optimal way to invest for your fixed rate investments. So this data that you see here is as of today. So you've got some government agency yields out there. We do have some FDIC and DTC CD product that is actually far surpassing what the market is actually going to be able to provide you. Now, if you're dealing with any type of capacity above the $250,000 mark, it absolutely makes sense to at least bid that out to see what you can get for maybe the $1 to $2 million that you might have above the FDIC limit. But you can see that rates are far and away better than what we have been seeing for the last 3 to 4 years. So any questions? Okay, well, that is all that I had for you guys today. I hope you were able to take something away. If you do have an opportunity to invest, I'd be happy to discuss that with you. Again, my name is Matt. I am the AVP of Investment Services here at PMA. There's all my contact information. So if anything here piques your interest or you have any questions at all, feel free to reach out.
Yeah, thank you, Matt. You know, I guess if I had to summarize what you're saying, if you go back just one slide, it looks like your thought, and again, I'm pretty novice at this, but your thought is that things can change pretty significantly, and the rates for longer term investments are good enough that if you can invest for a longer time period, do that now, even though it may not be quite as high of a rate of return as these shorter term investments. Is that fair to say?
Absolutely. That would be my recommendation.
And these are good rates. 4%,
Oh, yeah.
that's pretty spectacular for a very secure investment.
Mm-hmm. Yep.
Okay. All right, good. Well, anybody else have any questions? I know that we've got some folks who are active in this process of investing for their districts, and I did have one superintendent who reached out to me who was going to watch the recording because he said we've invested a lot of money with Matt and had very good experience, and he was looking forward to watching the recording. Now, Matt, the Fed meets today, and I guess if anything really substantial happens different from what we said, which is what you're expecting, a 75 basis point increase in the Fed rate, right? That's what you said.
Yeah, that's so probabilities are showing that it's most likely going to be a 75 basis point hike, but there's been more discussion over the last 2 weeks of potentially 100 basis points.
Okay. So if anything's substantially different than that, maybe we can spin back and just, do another 10 or 15 minute thing in a week or two and give people another update.
Yeah, absolutely. Cool. We'll, like I said, we'll be getting a ton of data this week. We'll be getting the Fed's comments, which really opens the window to sort of view, kind of gives us an idea of where they think they're going to go in the near future. So,
and the Fed meets quarterly?
No, they meet, I believe, is it 12 times per year? So sometimes it's on a consecutive month basis. Sometimes they'll skip a month.
Okay.
So yeah, it's they. I think it's maybe it's 10 times per year, but yeah, it's on an inconsistent basis. More or less, it's in line with when they receive their economic data.
Well, barring any other major events, we'll plan to get together for another market update in spring, probably March or April, maybe the day after the Fed meeting in the spring, so that we can leverage the latest news and events. And Matt, thank you so much for joining us again. On behalf of AEF, we appreciate your time and expertise. And I'm going to stop the recording now. And unless anybody else has any questions, we'll see everybody again in spring.
Thank you, John.